Okay, so we are starting up ledger today. Ledger is basically a classification. Let's see what is meant by ledger. The question is, what are ledgers? After recording the transaction in journal is a primary or the basic entry which we are making it journal, right? After recording the transaction in the journal, we need to post the entire transaction into a ledger. Recorded transactions are classified and grouped. This is called ledger. Ledger is an account book. Ledger is an account book which contain all account ledgers or all account heads like a sales ledger, purchase ledger, and all that. Okay. For example, all cash transaction is been recorded in cash book. Cash book is a subsidiary book, is a type of ledger. All purchase transaction is recorded in purchase ledger, or sales transaction is recorded in sales ledger. Okay. Other names of ledger is principal book, okay, secondary book of entries, and final book of entry. The ledger is also called as principal book, is also called as secondary book of entry, is also called as book of final entry. Okay. This is a format of ledger. We have a date, we have a particulars, purchase or sales. We have a JF, right? This is basically a J means journal, F means folio, journal folio. One side we have a debit, other side we have a credit. This is a format of a ledger. What is posting? Posting is nothing but transferring the debit or credit entry from journal to a ledger is called posting. What is posting? Posting is nothing but transferring the debit and credit item from a journal to classified account in the ledger is known as posting. Okay. Posting is nothing but transfer of entries from journal to ledger. Important point. Every ledger has to be balanced. That means total debit side and credit side should be tallied. And again, you cannot record the transaction as you feel. You need to record the transaction in chronological order. Journal and ledger records transactions in chronological order. Principal book of accounts, nothing but, ledger. Principal book of account is known as ledger. Okay, so let's see the multiple choice question. Just go through that. The first question. Okay, the first question, the process of transferring the debit and credit item from a journal to the respective accounts is called as posting. The question is the process of transferring the debit and credit items from the journal to the respective ledger is called posting. The second question, right? Second question, The second question, the technique of finding net balance of an account after considering the total both debit side and credit side appearing is known as is called balancing of account. What is balancing of account? Balancing of account is nothing but technique of net balancing it of an ledger is called balancing of an account. Okay. Journal and ledger record a transaction in a chronological order. Whatever is happens on the first date, it will be posted. Second date, next posted. We cannot jumble the transaction. Okay, so journal and ledger or records a transaction in a chronological order. Okay. Fourth question. Ledger book is popularly known as principal book of accounts. Please remember, journal is called primary book of accounts. Ledger is called principal book of accounts. At the end of accounting year means we call it as a financial year, that is April to March, all the nominal accounts of the ledger will be transferred to P&L account. The order which we call it as, the way in which we, take it up, or the account is basically, so first we will write journal. Okay, first we will write a journal. What is next? We will write ledger. Third one is trial balance. Then whatever from trial balance will be transferred to P&L. From P&L we'll be doing balance sheet. Okay. Transferring the transaction from journal or particular item of one place in the form of account is called posting. Let's understand. Cash sales 50,000. Cash collected from debtor. Debtor means receivable 1,30,000. Bad debts during the year 5,000. Debtor at the end 1 lakh. Total sales as this first year of business is how much? They were asking what is the total sales. Cash sales 50,000. Cash collected from debtor is 1,30,000. Okay. Bad debts 5,000. Okay. So what is the total sales? Total sales is equal to cash sales plus credit sales. Total sales is equal to cash sales plus credit sales. Okay. So here cash collected from debtor, right, is also considered as sales. So cash sales 50,000. Cash collected from debtor is credit sales. Bad debts sold but not received. Alright. And this is I supposed to receive debtor at the end. So my total sales will be my total sales will be 50,000, 1,30,000, 5,000 plus 10,000 is equal to 1,30,000 plus 50, 1,80,000, 1,80,000 plus 10, 1,90,000 plus 5, 1,95,000. So the answer is A. Why I should add all these things? Cash sales is a sales. Cash collected from debtor. Debtor means a person who bought the goods on credit but not paid. Now he has paid. That is called cash collected from debtor. Bad debt means sold goods, but what has happened is the person has not paid. In our banking prevalence, it is called NPA, non-performing asset. Debtor at the end means it's a good asset or a good sales. That person has to give money. So that is also called as a sale. So the total sales will be 1,95,000. Okay. All of you understand this sum?
Yeah.
Okay, thank you. Super. Ha, good. Super. I was fearing whether in online classes how we can explain the sums and all that. It's okay, good. I'm feeling happy about that. Thank you. All right. Ninth question. If total of debit, all right, total of debit side exceed the credit side, we have a debit balance. If debit is more than the credit, we have a debit balance. If credit is more than the debit, we have a credit balance. Cash account will always show a debit balance. The reason is what comes in is debit, what goes out is credit. It is a real account. So if you have a cash balance, that means we have a cash comes in is higher than the cash goes out. Receipts are higher than the payout. So the cash comes in as debit. So we have a balance. It's called debit balance. Okay. Generally, the balance of capital is a credit balance. Why capital is credit balance? Capital is liability, right? Capital is given by the promoter. Okay. So what is a rule for capital account? Debit the receiver and credit the giver. This is a rule. Capital is a liability. The promoter gives the capital. Okay, it is called credit balance. All right. Debit and nominal account. Income is credit, nominal account. Asset, debit, and it is a real account. Liability is a credit and personal account. Okay. So NA means nominal account, RA means real account. Okay. Here the question is nominal credit balance. Nominal credit balance is what? Income only. Nominal credit balance is income. Okay, clear? Okay, super. So we are moving to a next question. In a ledger of account of a creditor, the closing balance will appear on the debit side. Ledger account of a creditor. Why? Ledger account of a creditor. The closing balance will appear in debit side. The reason is the creditor, he has to pay. Right. In our book, the closing balance means, right, ledger account of a creditor. That means creditor means a person who has given goods on credit, we are supposed to pay. Okay. In our book, it shows us a debit side of that because the closing balance will appear on the debit side. Okay. Ledger is a principal book that we have already discussed. Which of the following account will always have a debit balance? Cash will always have a debit balance. Okay. Discount, we need to see whether discount given or discount received. Normally, the following accounts are balanced. What is balanced? Personal and real account. Personal and real account is nothing but liability and asset. Liability is personal account. Asset is a real account. So this need to be balanced because the balance sheet will always balancing liability versus asset. Okay, right. That's it is called ledger as concern. We'll be moving into a trial balance now.